The DoubleLine Shiller CAPE ETF, CAPE, is one that invests in the various parts of the large cap equity space based on Professor Shiller's CAPE ratio.
The CAPE strategy in the United States tries to assess value in sectors of the U.S. equity market and tries to rotate to the sectors that it deems to be the most attractive.
The CAPE strategy that we run at DoubleLine looks at the CAPE ratio of the various sectors of the market and compares each sector to its long-term historical average. In doing so, it identifies which sectors trade cheap or rich relative to their history. And by identifying cheaper sectors of the market according to the CAPE ratio, it has a nice sector rotation process that we think adds value over the long term. When we were approached by Professor Shiller with his CAPE methodology, we really like the methodology because it really is rooted in how we think about the fixed income markets. We're looking for value in the markets, we're looking at risk-adjusted prospective returns.
Dr. Robert Shiller is a Nobel Prize winning economist and professor who has spent his entire career studying valuations in markets.
And in Dr. Shiller's work in the late 80s, he wrote a seminal piece with one of his graduate students, John Campbell, using a longer term earnings series to have predictive power of stock market returns. And so Professor Shiller has been known for his cyclically adjusted price to earnings ratio.
The CAPE ratio is a framework for assessing value.
You can be thought of as similar to a traditional price to earnings ratio, but instead of using something like 12 months of earnings as a denominator, it uses the price of something today relative to the inflation-adjusted average 10-year earnings. Having a long-term perspective of earnings in the denominator allows you to have a higher predictive power, whether that's at the security level, the sector level, or the overall market level.
Every month, we look at the 11 sectors of the U.S. equity market. We evaluate whether those sectors are rich or cheap relative to their own history using the relative CAPE ratio.
From there, those 11 sectors are ranked on their relative CAPE ratio to identify which are the cheapest sectors of the market. The cheapest 5 sectors of the market are identified as the universe that we want to look at.
And then we get rid of the sector with the worst momentum. In value investing, you don't want to be trying to catch a falling knife. By eliminating the sector with the worst momentum, we're attempting to control for that.
From there, you have 4 sectors of the market. You're going to put 25% of your portfolio in each of those sectors of the market. The next month, the process is repeated. If there's no change in sectors, then we rebalance back to those target weights. If there's new sectors, then you rotate into the new sectors of the market. And then the team goes out and purchases all of the equities that are in those various sectors. And so this is a process we've been using at DoubleLine for over a decade that we think adds a complement to value portfolios in the large cap universe. In today's environment where the S&P 500 has significant concentration risk, we think it's important for investors to have other solutions to invest in the equity market. The history shows that as concentration risk grows, it actually increases risk in one's portfolio. Although it's been a nice ride by owning the Mag 7 type of stock, we think that over the long term, there will be a mean reversion when it comes to valuation in other sectors of the market. And using a long-term value metric such as the CAPE ratio, what it allows an investor to do is find pockets that investors may not be focusing on in today's market. Even though we have an environment that has been driven by a very few stocks, this process is one that gives you a complement and has done quite well when there's bouts of market volatility.